So good morning, everybody. It's such a pleasure to be here. I'm so excited to be on the stage with these two wonderful people as well. Just quick overview of what I'd like to accomplish with this panel. First of all, how many of you have worked with a CDFI before? Okay. So CDFIs are the world's best kept secret. So what I'd love to do is just provide a little bit of background on what CDFIs are and what role they play in the community development finance field, and then hear from two leaders in the CDFI industry more about what their organizations do, what kind of products they offer, and then we're going to kind of do a bit of a conversation about where the field is headed and how CDFIs can evolve to meet that demand. So really quickly, in terms of community development and community development finance, I would say, and you know, if you guys see it differently, but I would say the modern community development finance industry really was born when the Community Reinvestment Act was passed in the late 70s. So CDFIs actually predate the CRA, but they were supercharged by the CRA when it was passed in the 70s. And you know, one of the reasons that the Federal Reserve, of course, is involved in community development is the CRA. And for those of you who aren't familiar with it, it was predominantly an anti-redlining piece of legislation that basically prohibits banks from cherry-picking business from rich neighborhoods and ignoring poor neighborhoods. So that's kind of the big picture purpose of the CRA. But more importantly than that, or equally important to that, it created a new incentive for banks to invest in and lend into low-income places. And that was really, I think, what as I said, supercharged the CDFI industry. And those projects, of course, are the ones that we're familiar with: health clinics, affordable housing, grocery stores, community facilities, and the role that CDFIs, and CDFI, for those of you who have not worked with a CDFI before, stands for Community Development Financial Institution. There are a lot of acronyms in community development, and CDFI is one of them. But CDFIs really play an important role facilitating bank capital into those community projects. And the way that I think about it is, you know, take a bank like Bank of America, and not to pick on Bank of America, like Bank of America. Any large national bank that has a CRA obligation. So Bank of America is everywhere, right? Every community, every neighborhood. But if you're everywhere, you're also nowhere. And that's where CDFIs come in. Banks just don't have the local knowledge of what their low-income communities need. And so they depend upon CDFIs to do that work for them. So they facilitate the investment and lending that banks have to do to fulfill their CRA obligation as enforced by the Federal Reserve, the OCC, and the FDIC. So that's kind of the big picture landscape of community development finance and where CDFIs fit in. But I'd like to turn it over to the real experts, the people who actually do this every day. And Nancy and Ellis, and Nancy, why don't we start with you? I think everybody here would love to hear more about what LIFT does, what gaps you fill in the community development finance field, and why would I go to you as a community partner and not Bank of America or Wells Fargo or another financial institution?
Sure, I'll start, and I'll try to get through those questions, but if I don't, we'll circle back at a little point later and make sure we complete answering all of those questions. But just to acquaint you all a little bit with the Low Income Investment Fund, we grew up out of the war on poverty, much as Ian said. We are an organization that is dedicated first and foremost to poverty alleviation. We see our mission as doing the things that are necessary to allow people to lift themselves up economically. And we also see the issues of justice and civil rights as being absolutely integrated and entwined with the work that we do. When we got started, we were started about 30 years ago. We were actually started in the Bay Area of San Francisco with a small amount of money from the Jesuits. And at that time, the theory, the felt need was, because there was so much disinvestment in the places that were poor, it was essential to find ways of bringing capital to invest in particularly affordable housing. The Low Income Investment Fund got started as the Low Income Housing Fund. And we used money that originally came from religious institutions as our first capital base. And what we tried to do was get so good at lending money to neighborhood projects, affordable housing primarily, to be so excellent at that skill that we would prove it to our banking partners, the banking friends that we had in the Bay Area, that this was a good investment and these were worthy projects for them to direct their capital toward. At that time, it was almost impossible to get banks to provide capital for multifamily affordable rental housing, for supportive housing, for residential facilities that served homeless people or people with special needs. And our goal was to do such a good job at making these loans and proving that these projects were worthy and would repay back, that the banks would see the light and would come in with their scale and their resources and lift up the communities that had been left behind. I'm thinking a little bit about the exercise that many of us just did about being unseen and what that does to your psyche. And you can think of these communities as communities that really were unseen by the larger economy and by larger institutions. And so we were really trying to shine a light on the value that they carried and the assets that they possessed. Fast forward, we've been around 30 years. Fast forward, we found that not only did we succeed in proving that these were good and worthy assets and good and worthy loans that could be made, we succeeded in bringing our banking partners in to work alongside us. And then there was so much demand for what we did, we found that we actually needed to open offices in Los Angeles, in New York, and in Washington, D.C. We've gone far beyond housing. Somewhere along the way, we figured out that it takes more than just housing. Housing is a fantastic platform, but all by itself, it won't do enough to really allow us to achieve our mission of lifting people out of poverty. And we began to understand that it takes many sectors, many disciplines, many silos coming together, working together comprehensively. And so we added early learning and child development in about 1998 to our work. We added education somewhere around the year 2000. So we began investing in schools. We added, about 8 years ago, we added health. And we also are very keen on transportation, transit-oriented development, because that is an opportunity for people to get themselves to where opportunity is. So right now, the Low Income Investment Fund has 5 areas that we make loans in: affordable housing, early learning and child development, education, transit-oriented development, and health. And the basic business model for how we work is we are able to convince banks to provide large-scale capital to us. They look at us and they see us as safe and sound and excellent at lending, so they're willing to make large investments in us, say $20, $30 million loans to us. We then take those large investments and we break them down into smaller chunks that are appropriate to neighborhood scale projects. And we have done that for years and years. We've deployed over $2 billion of capital in community-based projects. And we are the thing that we're proudest of is that using those funds, we've actually served about 2 million people. We've supported 70,000 homes for families and kids, about 80,000 desks in schools for young kids, and about 250,000 spaces in childcare centers for young children. So all in all, this has been an incredible experiment, an incredible ride. And you see an organization like LIFT that started 30 years ago with a small capital donation from the Jesuits, about $500,000. We are now an organization that has about $1 billion of capital to apply to our mission of poverty alleviation.
Thanks, Nancy.
Awesome. It's great, Nancy. As I listen to Nancy's story about LIFT, it strikes me how similar our stories are for our organization. And Capital Impact Partners is also a national nonprofit community development financial institution. We're headquartered in Arlington, Virginia, with offices in Oakland, California, and Detroit, Michigan. Our vision for our company is a nation of communities built on the foundations of equity, opportunity, inclusion, and cooperation. And as Nancy's organization is as well, we were founded about 30 years ago as well as a way to align capital with social and economic justice. And we do that in a number of different ways. We provide financing and technical assistance across 4 main areas: education, healthcare, housing, and food. And we see that as a way to really provide access to, again, lift people up and provide both the access, but also the opportunity. Being able to develop, build community wealth, and through education and quality services. We have, as Nancy has mentioned as well, we leverage public and private dollars to be able to deploy into markets. We currently manage about $1 billion of assets on our balance sheet, and we really look at it as a holistic approach to providing capital and resources to affect positive change in communities. And so, as the name indicates, we are also focused on financing, but also we do a lot of technical assistance to really help with our borrowers to understand the types of loans that they're taking on, and then also look for holistic solutions around providing policy and advocacy work to partner with folks, CDCs and local community facilities on the ground, to really be able to develop a proof of concept that can be potentially portable from one place to another.
So that's really helpful, and I just want to follow up on that.
Sure.
So walk us through. I mean, for the folks who have not partnered with a CDFI before, how does this work? Right? Do I? You know, I'm a community organization. I have a capital need. Do I Google CDFI and click on the first link? You know, do I knock on your door? Do I call my local Federal Reserve representative? What do I do? You know, how does that process work? How do they get engaged with your organizations?
So I'll start out, Nancy. So for us, we have business developers, we have loan officers who are at conferences like these, but also that are embedded in the community. Giving you an example, we do a lot of work in Detroit, and we were invited in about 10 years ago from other foundations as well as local CDCs and other community partners to be a part of a local collaborative to help densify an area in Detroit. And so we were able to develop and build our partnership to the place that we actually opened an office there, and really can have people come in and engage with us in that way. Okay.
Yeah, and the same is true for the Low Income Investment Fund. We tend to target the locations where we have physical offices, although we actually work in 30 states around the country, but the bulk of our work, the vast majority of it, is in San Francisco, Los Angeles, New York, Washington, and the Mid-Atlantic area. We're very interested actually in strategically beginning to explore whether there's a role for us in the South. Are there opportunities for us to be engaged and to be helpful? And we have, just as Ella said, we have loan officers who get to know organizations that are doing community-based work in all of these communities, and learn about what their mission is, what their goals are, how they're going after their goals, where they're at in their process. And we begin to explain what resources we have, what tools we have, and to see if there are places where those tools and resources fit with the needs of the organizations that are engaged in community building and poverty alleviation work. So it's kind of like it's like developing lots of friends, and staying in touch and getting to know what they're doing and trying to figure out how we can help.
That's great.
I think it's also important, just as we talk about, we said loan officer, and I think that probably has a certain connotation, but the loan officers that we're talking about really are taking an interest. They're mission-minded. They really understand the market. So if it's education or healthcare, they're studying the Affordable Care Act. They're looking at performance of charter schools versus others, and they're really trying to develop products that will really help us move the needle in terms of poverty alleviation. So they're really partners, friends, to really work with folks in the community to be able to affect the positive change that we're all looking for.
And I wanted to just add one little note to this before we go down into the nitty-gritty of exactly what it is we do and the granularity of our work. I want everybody to kind of get the big picture of what we're trying to do. So we not only are trying to provide a resource that will allow communities to rebuild and allow worthy projects to flourish, but we're also trying to learn. Everything that we do when we work in a community is an effort to learn about what's working and what's not working. And we then try to take those lessons across the country and bring them together and lift them up, lift up what's not working, lift up what is working into the policy, the state, the local, the federal policy arena, and actually change systems and the way in which resources are delivered throughout the country. So we may take a lesson from one state that we're working in and use that as a basis for saying, we could be so much more effective and our partners could be so much more effective if we could change this rule or that rule. And we succeed actually in doing that. And when we do succeed, we are able to mobilize much more in the way of support and resources that go throughout the United States. So you can think of us, I like to say, we got boots on the ground, but we got a brain on our shoulders, and we want to, at the end of the day, what we really want to do is think and make social change.
That's right. And that's actually a great advertisement for our book, Nancy.
Yes.
So I think everybody can see the tile up there, Investing in What Works for America's Communities. That was a book project in 2012 that I had the privilege of working with Nancy on. This was a partnership between the Low-Income Investment Fund and the Federal Reserve Bank of San Francisco. And the goal with the book was really to do exactly what Nancy just mentioned. Try to wrap our arms around what is working in the community and how can we distill those learnings down to some common themes that will help us improve the industry, make it more impactful, more effective, more efficient, change the systems that drive all of our work. So I encourage, and I know this is a plug of our own book, so I'm reticent to do it, but it is free, so it's not like I'm making money off of this. But if you go to the website, you can download all of the chapters, you can order a book, we'll mail it to you for free. But it's a really nice one-stop shop for best practices in the community development industry, and one of those best practices, of course, is purpose-built. And that's actually how I originally got connected to the purpose-built folks, and I've never left. So before we pivot to purpose-built, because I want to ground the CDFI conversation in the work that you all do. But before we do that, I think we have to spend a couple minutes on the actual products. right? So what are we talking about when you're lending into education, health, community wellness? What kind of product offerings do you have, and how do they work? And I don't mean a deep dive into the mechanics of the low-income housing tax credit, but it would be helpful to know what's, when I show up, when I meet with one of your loan officers, what's my menu? Any just quick thoughts on that?
Sure.
Sure. So I think, as I mentioned before, as we both mentioned, I think our folks are really trying to understand what we're trying to accomplish, like what is the ultimate goal. But ultimately, I think we have a suite of products that look at both from construction or acquisition all the way to permanent financing, so 6 months to 30 years. But I think the beauty of a CDFI is our ability to be able to structure for a specific need. I think that's where we're different from traditional banks, because we are able to pull capital from a variety of sources. So from foundations, both debt and also grant capital, from traditional CRA banks, and from the federal and state governments, to really put together something that actually works. So acquisition for a new community facility, for the bricks and sticks, so to speak. Equipment financing, it could be factoring on receivables, et cetera.
Yeah, so we will help groups actually acquire a site that is not developed yet, or maybe has a building on it, but that building needs to be renovated. So we do, this is in banking terms, it's called the land loan. This is bad. Banks don't do that. They don't like that.
Yep.
We do that stuff. We call it acquisition lending. So we go out early and we stick with projects for a long period of time. We will do construction lending when banks aren't willing to do that. We'll step in and do that for not-for-profit organizations. We will do short-term bridge loans that allow you to get your other financing lined up, and so we'll take a bet as you're doing that you're going to succeed, and then the other financing is lined up, and that will make us whole. And just in the last couple of years, we've had access to something that was a legislative innovation that we advocated for, and that is 30-year long-term money through a bond program. So we've managed to get legislation passed that allows us to have our own bonds for community development, and we can make long-term 30-year loans just like mortgages using that facility. We also are able to mix and match all kinds of federal tax credits, the new markets tax credit, the low-income housing tax credit. We have a hand on all of those different resources. And what I think our staff, we call them loan officers, but really they're artists. They're financial artists, because they're able to assess the needs of communities and nonprofit organizations and figure out which of one or another type of capital can be blended together to actually make the project go forward. So we do all kinds of, it's called structured finance, but you can think of it as the wild and crazy creative side of making this mission work.
Not dissimilar from community quarterbacks.
Not dissimilar from
You're a financial quarterback. We're coining that today. So that's, let's pivot a little bit and talk about purpose-built specifically.
Add one thing. I mean, I think it goes without saying, but I think there's an implied or risk that financial institutions, specifically banks, may look at in terms of underserved communities, and that's why they look at CDFIs to do that. And I think we're uniquely positioned to be able to really highlight what the real risk is. And we have risk management practices, and we actually have a thorough knowledge of being on the ground to be able to leverage our investment that we may put in, say it's $1 million, to bring in $5 million of other capital. So we are able to potentially take the more risky or perceived risky piece of a particular transaction to bring in other partners who may be more conventionally suited to provide financing.
That's a good point.
Can I jump in with
Yeah, go ahead.
something as well? So I really want to make sure you all know how transformational your work is.
Absolutely.
We have learned so much by listening and learning and trying to get to know the various purpose-built communities across the country. And I personally was so inspired by the model that I actually rounded up everybody on the management team at the Low Income Investment Fund and invited myself with my team to Atlanta, or to New Orleans rather, and we spent 2 days looking at and understanding how that project and how that effort worked. And while we were there, we actually did a little bit of brainstorming with some of the staff from Purpose Built and came up with the idea that what organizations that are trying to put many pieces together, many programs together and make them work together, what those organizations need more than anything is capital that is highly flexible and patient, but has a strong social outcomes focus. And so that led us in the room in New Orleans to invent a whole new capital approach that we call equity with a twist. It really is organized around the purpose-built idea of combining affordable mixed-income housing with early learning, K-12 education, community wellness, excuse me, and we wanted to call it equity, not alone. The reason we wanted to think of it as equity is that it's intended to be highly flexible so that you don't necessarily have to pay a certain amount of interest every quarter or every month. It has the idea of a yield, not an interest payment. And on top of that, the word equity has a double entendre meaning. It means something about raising and lifting all people so that we can live together in an inclusive economy. So we were working on all of those ideas and trying to infuse them into a custom-made source of capital. We actually invented that and then managed, God bless Chase. Chase Foundation agreed that this was a really important thing to do. And so they gave us $3 million and we put up $3 million of our corporate reserves and we created a $6 million pool to invest in integrative planning, integrative programs that have outcomes as their guiding guidepost. And we're still experimenting with that. We've just actually finished deploying those funds. But that's an example of how what you're doing is inspiring to us and how we try to respond by creating different capital approaches that serve mission purposes.
Mm-hmm. Yeah, no, I have an opportunity just because I have this very strange job to just think about community development all the time, and to me this is really the beginning of a sea change in both practice and in financing, and Purpose Built is at the front of that evolution in the field, but our financing tools have lagged. And with the exception of these two exceptional people and organizations, we're still implementing, in my view, a 20th century community development financing model. And the way that I kind of think about it, big picture, is we had a theory of change in the 1960s and 70s when the community development industry was born, that if you just fixed the neighborhoods, right? If you cleaned up the housing, you cleaned up the streets, you built some community facilities for people to come together, then the people would do better, right? You put them in a context, a physical context, to be successful, and they will succeed. And that really is what led us down the path to affordable housing, to mixed income housing, to community facilities, to health centers, to charter school facilities. And I think the theory of change was right, but ultimately insufficient. And I think what we all know is that for a lot of the communities that we care about and the communities in which we work, being in a better housing unit, as great as that is not enough, right? You need the human capital skills to succeed in life. But there are no financing tools for human capital, right? Community development as a field is place-based. And place is a really important starting point, to Nancy's point. It's the foundation upon which we build human capital. But we've been locked in this dichotomy of is it people, is it place? Well, if it's not place, then how do we address people? And I think this is the path that Purpose Built has started to navigate, and you're seeing CDFIs adapt to meet that need. But I think the challenge in this, and just kind of open up the conversation, I think the challenge is you guys need to get paid back, right? At the end of the day, you're not foundations. And the nice thing about a building is it generates rent. It's a source of cash that pays back debt. Purpose-built communities are much bigger than that, right? The organization, the community quarterback that does the coordination of the community partners on the ground isn't a building. So, in your view, what role can CDFIs play in the future, beyond equity with a twist, to support community scale neighborhood transformation? Do we need new tools? Do we need a new role for the federal government, new subsidy sources? Do we need a new category of institution? And not to this, I'm sort of springing this question on them. But I think it's fascinating. I think we're at this inflection point as an industry. I know that term is overused. But I think we're at this inflection point where we have to acknowledge that investing exclusively in place is not going to get it done. And we need to start thinking more creatively about the financing tools that are out there to invest in human capital.
Yeah, I mean, I very strongly feel that we need to, we are on the cusp of a paradigm shift, and that paradigm shift is leading us away from silo by silo, asset by asset, capital investing, and it's leading us much more toward the idea of investing in enterprises and investing in outcomes and keeping everyone aligned on the big picture of what it is we're trying to accomplish. And even as I sit here speaking to you, our policy teams are actually working on ideas that would lead us toward the creation of a community quarterback fund or a community quarterback program. Ellis and I will be in a meeting in Arizona or Tucson in a couple of weeks, and this is going to be on the table. What do we want to promote from a policy point of view? And I'm in a very strong position of wanting to create the kind of, I would call it, excuse me, white space money. It's money that allows the silos of our practice, the people and the place parts of our practice, to be linked together. You can't do that if you're stuck within a silo, but you can do that if you have a little bit of white space and a little bit of freedom and free time to step back and figure out how to knit these things together and how to build, how to move toward a bigger picture. So I think there needs to be resources coming from the federal and the state level to enable that. I think we as community capital providers need to break the box down and come up with new products and new boxes that encourage that kind of investing. And equity with a twist is a starting point, but there's so many other things that we could be doing, and we intend to take it all the way to DC.
So completely agree with that. I think to Nancy's point, I think broadening the tent to bring more players into the mix to have these conversations around what success looks like, to basically coalesce around a common goal, and even getting outside of folks in the community development finance space, even purpose-built community space, and really looking really broadly at kind of broad social change. There is a momentum in this country that is beginning to focus on justice issues, and we need to be able to capitalize on that. And I think that we've been thinking about that a lot internally, and we're developing a product that allows us to raise capital from Main Street, from folks who are really allowing them to basically put their dollars in alignment with kind of their values. And so being able to do that in a way that is at scale allows us to address some of these social issues. I think it's also, to Nancy's point, finding ways to invest in social enterprises. Another movement in the country is around B corporations, benefit corporations, who may be for-profit, but they are also very focused on this type of social change that we care about. So we're looking at developing pools of capital to provide equity investments into them so that they can affect positive social change, and then using our resources at will to bring things to scale. So just to give you an example, we put about $500,000 up for another CDFI to have access to bank capital to provide small business loans in Detroit. We don't do small business loans, but at the end of the day, that is a way to create economic mobility and pathways out of poverty. And we felt like we needed to put our money to use, so it's not necessarily to a traditional borrower that we would typically lend to, but it's another partner to affect the broader social change. So I think we have to think differently. I think we need to kind of erase the thought of who we typically work with in terms of our customer base and really widen the tent to really affect broad social change.
I love all those examples, and we've only have about 10 minutes, and I'd love to get all of your questions as well. But just to wrap this up, I love sort of the term enterprise level financing. Not because it's a little bit technical, but I love the potential of that term in the sense of thinking about the social sector. Most of our community partners have historically operated from sort of a charitable mindset, right? That we have problems in the community and we're doing everything we can to address those issues. What I love about this direction that I think we're all going in is, instead of thinking about organizations on the ground as fundamentally charitable, we think about them as enterprises that create value.
That's right.
Right? And if they create value, then we can finance them. But it's that first step of sort of reframing the work. This isn't charity. This is creating real, tangible, measurable value that should be paid for. And if it's going to be paid for, just like any other enterprise, then you create a financeable opportunity for a CDFI to play an important part. So that, to me, is just what's so exciting about the evolution of the field at this moment, and all of these tools that our financing partners are inventing to meet the demand and the need. So we have a little bit less than 10 minutes. So if you have a question, please come up to the microphone, because I think we're on camera.
Hi, thank you for this session. I'm Bob Wimpelberg from Houston and the Connect community. Two questions. One, I was going to simply ask Nancy, in what sense were you a disruptor? Ben Heck gave you the award, but I'm guessing it's because of your and Ellis's interest in investing in capability building and enterprise. If it's different, tell me. The second question was, so we know what works. What sorts of things have you invested in that didn't work?
Okay.
So I can start with the hasn't worked as well.
Okay. Lead on.
So one of the things that we developed in California was a large bucket of capital called a fund to provide, to help end food deserts in California. And to develop something of scale, we're talking about $70 to $100 million, it takes time to develop. And during that time, really the dynamics of the communities that we were trying to affect change in changed. Capital began to flow into some of those markets, and by the time we've developed kind of the financing package or the structure, the environment had changed dramatically. And so we had to begin to course correct. And it took us a long time to do that. So for us, it was a lesson learned on really starting a little bit smaller. We see the needs, finding different ways to bring capital directly to us so that we can respond in a timely manner. And so we did that. And scaled down the program and developed a corner store conversion program that really provided small microloans to some of these convenience stores, which were being utilized for grocery needs in lower income communities to provide healthy food options in those areas.
Yeah, and I'm going to go back to the question that flattered me, which is how am I a disruptor? And the first thing I want to say is I was born and raised in North Carolina and Virginia, and being a disruptor wasn't necessarily considered a good thing. So I had to live this long to actually have something to get an award for it. And I think it really came just from the force of personality, but the specific things that they focused on were trying to break down the walls between the health sector and the housing sector, so trying to create experiments that pulled those two together. And then the second is we pioneered a tool called the Social Impact Calculator that was monetizing social value from capital investment and express social value in terms of return on investment. And that caught people's eye. So thanks for that question. As to what didn't work, I would agree. We had a really tough time in making the healthy food financing fund, excuse me, that we created go. It was a hard slog. We haven't been able to get much traction in workforce development. That's an area we tried early on and just were not able to move the dial. And likewise in small business investing, we don't see that as a fruitful area. So.
And I'm glad you mentioned the impact calculator. People can find that on your website?
Yes, and that would be, I don't know what it is, liftfund.org/calculator, I think. liftfund.org/calculator.
It's an amazing tool. I encourage all of you to go check it out. Yeah, right here.
He said he's first.
In working in small single-family neighborhoods, are loans made in bulk, if you would, based on the performance of an individual project, house by house? And also, a lot of mention the other day in Woodlawn about money that was made for housing rehabilitation, and it came from funds that were directed to other programs that never were expended and somehow converted. And could you speak to that rehab piece for a minute?
I don't think I know that example, but on the single family question, yes, we have done that. We don't have a lot of call for, we've had revolving loan funds that are on a, for single family model where you go in and you do one and then you quickly turn and do another. We've done that. It's very labor intensive. Doesn't have a lot of scale behind it, but we have invented and created ways of addressing that need.
I think for us, again, going back to my example before, we look at different ways to invest in organizations who need to affect the change that we want. And so in Detroit in particular, we've looked at ways to provide equity capital for a developer who is looking to acquire a large parcel of single-family homes, some of which are vacant, so that they can rehab, and then helping them to create capital source so they can rehabilitate those and put those on the market.
Yeah.
So we're running a little bit short on time, and we've got 4 questions. Okay, well, my thinking was if you guys are okay with it, maybe we could ask 2 questions in quick succession. We'll answer them, and then we'll take the next 2, just so we can get all 4 of you in.
So thank you for being here. Thank you for sharing your experience. I'm here to plug for you to come to South Florida. We desperately need this kind of activity in our region. I'm in West Palm Beach. We're trying to pull in a purpose-built community model and become a network member. We also have a TOD that we have been working on for 15 years. Wow. And not just because we have so many projects that I think that a CDFI presence would help get off the ground. But more importantly, what we have been told by Chase is that there's just not enough capacity in our nonprofits in the South. And I think that would help tremendously to help build that capacity. So I'm just a plug to come to South
Thank you for
Florida.
that.
So Sajin Phillips, raise your hand. Go talk to that lady.
Picking up on that theme, Dick Fleming from St. Louis, and my question is about connecting the dots. I am blown away at the capacity in this room and what Shirley and Carol have put together, and 17, and their aspiration for 800. And in the last 2.5 weeks, shopping a 1,500-acre mixed-use inner-city mixed-income project in St. Louis, have had the occasion to be in 2 places that I wonder how they can connect to what's happening in this conference. We were at BlackRock for a day with their top people in infrastructure that we hoodwinked as CEO into getting us in the door. And he recited the fact that Lawrence Fink had sent a letter a couple of months ago to each of the Fortune 500 CEOs. Fink is the CEO of BlackRock, who manages $4.8 trillion, saying, we are now going to consider social impact when we're evaluating investing in your company. So please begin to articulate, and I think they should talk to Nancy based on what she just said a minute ago. And then we spent a day at the AFL-CIO Housing Investment Trust with Steve Coyle talking about the existing $5.8 billion that he has in housing and the new fund he's creating for pre-development. How do we connect those resources with the capacity that are represented in the range of purpose-built communities that we're here today celebrating? And I'd love to hear more about your social impact indicator.
Sure, yeah. How do we connect?
So I was going to say, I think
Go for it.
one of the things that that we've both been working on and looking at is looking at the next frontier around who we can partner with from a capitalization perspective going forward. I mentioned figuring out, developing and I think the biggest way to do that is through a product. So for a long time, CDFIs have basically leveraged capital from CRA banks, foundations, and others, but now we're looking at providing products that can go to a BlackRock. So the product that we're developing is hopefully we'll be able to get on a platform like Charles Schwab, Fidelity, et cetera. We'll be able to be invested in by a BlackRock, mutual funds, and others, so that folks can channel capital through us to source deals of that nature. I would say too, and there's a lot of conversation, and I think it's the right one, to move towards outcomes-based financing, I think, but at the same time, I'd just say that you know that there's a community that needs a good school, and if you don't necessarily have the whole outcome conversation ready to happen, that still should mean that school shouldn't go forward. So I think, let's not let perfect be the enemy of good and continue to move forward to make sure that we provide the support we need for the communities.
So can we get both of these questions really quick, and then we'll wrap it up?
Hi, Ralph Davis from Rome, Georgia. 2 quick questions. The interest rates that you charge, how do they compare with the regular banks? Another question is the comment about the corner store conversion program. What do you look at as far as considering such an entity in the neighborhood, corner store conversion?
Can you just, that last part I just...
What do you look at as far as converting a corner store to expanded grocery store?
Okay, sure.
Okay, perfect. And then last question?
So Ellis, you just referenced this a little bit, and Nancy, you talked about it earlier, but so I'm a nonprofit here in Birmingham, and we see needs, capital needs, and small business lending that we do, commercial real estate, and healthy food finance. Everybody's talked about how the South is the uncharted territory for many CDFIs. So what would each of you included again, say would be good kind of filters for us as we evaluate who we should look to partner with, and how we can get additional resources for those various programs into our work.
So maybe we start with that one since it's
Sure,
fresh.
go ahead.
I think, and this was referenced yesterday, I think at lunch, we've also been looking at the South and other places across the country to expand into. And I think for us, as we look at kind of what is the criteria that by which we would become more interested in an area, I think the civic quarterback, I think, was referenced earlier, someone who really understands the local dynamics, particularly in an area that we don't. I think other partnerships, both philanthropic and in the government, both local and state, would be also things that we would look at to help us make a decision to move into a specific new space.
Yeah, and I would say something very similar. I mean, we've developed a relationship with Purpose-Built and have done investments in a number of Purpose-Built communities. We would certainly look to Purpose-Built as helping us find feet on the ground. There are other CDFIs that are colleagues and friends of ours working in different parts of the South, and we would see ourselves as buddying up and partnering with them and working through them for projects and opportunities rather than trying to, come in from the outside, just jumping in.
Yeah, just as an example, a practical example is we did exactly that in Detroit. There were several CDCs and small CDFIs that didn't necessarily have the capacity to aggregate to affect change in this area. They brought us in as a national CDFI with resources and partnerships and expertise, and we were able to work with them and partner with them to do, as I mentioned, small business lending, commercial, mixed-use commercial real estate, and kind of affordable housing in place. So I think there's opportunities to connect organizations like ours, which have a national breadth and depth in certain sectors, to partner with local folks on the ground to do things.
And we're getting the hook here, but really quickly, interest rates as they compare?
Depends.
Yeah, it's, it can range anywhere, depending on the project, risk, what else is going on, it can range anywhere from 5.5 to 6.5, maybe even a little bit higher %.
Okay. And I'll just take my moderator's prerogative here, even though Kathleen's going to kick me off the stage here. Just to answer that second question. If I was a nonprofit and looking for funding, I would think really hard about who benefits when I succeed. And it can be a host of unconventional partners, organizations, different levels of government, and then approach them and make a value proposition. If we succeed, you're better off, you save money, you can sell more products, you can shut down a service that's no longer necessary. Help me succeed so that you can succeed. Put a price on that and raise funding that way. There are so many organizations out there who should be partners in community development work, in purpose-built community work, who aren't yet. And so it's really important to, I think about your value proposition and then sell that to as many partners as you can. So.
I'm really not trying to shut this down. I have to get on a plane.
I literally have to get on a plane.
Good luck,
I
kids.
think Nancy and Ellis can stay if there's some more questions. But we're going to have a short 15-minute break, and then we'll come back with 2 other really good breakout sessions. One that will follow up very nicely to this, which is philanthropic innovations and community revitalization that will be back in this same room. And then across the hall will be assessing neighborhood health. So those will be the 2 breakout sessions, and then we will culminate with our closing luncheon. So thank you, and give all of these guys a great big thank you.